it is time for some great financial advice. And who better to give it to us than Tommy Corbett from Carey Corbett Financial Solutions. Tommy, how are things?
Morning, Alan.
Thanks very much for being with us. So, you are, I suppose this is a kind of a three-parter. You're going to talk about financial priorities for people, but people in different age demographics, specifically, you know, what your priorities are in your 20s, then your 30s, and then your 40s.
Yeah, so I suppose we look at kind of 20s, 30s and 40s today, and then as you get older, and I suppose it's something we see I suppose every day of the week in that people in their 20s come in are completely different in general. People that come in their 60s, their financial needs are different, what they should be looking at is different, and I suppose it's just a couple of pointers really in relation to clients and listeners as to what they should be looking out for depending on their ages and that kind of stuff.
Okay, so in terms of 20s, what is the key area? Is that where you should really start building up that pile of cash?
Yeah, so sort of I suppose in your 20s really, I think it's about, you know, forming good habits versus bad habits. And what I mean by that is good habits in relation to budgeting. You know, and I know, you know, you finish college or you finish your apprenticeship and the last thing you're going to be thinking about is budgeting. But, you know, even if it is to go away on a holiday with the lads, you're going to, you know, rather than putting it on the credit card, maybe save it and have the spending money there. Or you want to go travelling, etc. So what I mean by good habits is, you know, not racking up debt, ensuring that if you do have a car loan or a credit card, that it's paid off and it's paid on time, that you don't end up with a black mark on your credit history. So kind of forming those good habits, you know, even savings on a weekly or a monthly basis. You know, what I would say in relation to savings is when you get your paycheck, whether that's weekly or monthly, save first, spend after that. You know what I mean? So if you decide I'm going to save, you know, 100 quid a month, that comes out the day basically that you get paid, and it's put somewhere you can't touch until you actually need it. Okay,
what about into your 30s and then your 40s? What should you be looking at, the key areas in terms of maintaining a budget?
Yeah, so then I suppose again, into your 30s, and you're probably looking at different things. You may be looking at maybe getting married, starting a family, looking at a mortgage, saving for a deposit, all those kind of things. Again, if you do have children, you're looking at probably childcare, you know, as I said, rent or a mortgage. So you're probably looking at bigger goals and possibly then retirement. So maybe you're working for someone or in an industry where they do provide you with a pension, or you may be auto enrolled, etc. So those kind of things become a little bit more of a priority as you get older. Again, emergency savings, you know, in your 20s, you know, you kind of aim to have 3 to 6 months core expenses that basically, if you lose your job or are unable to work due to illness or injury, that basically have a few quid put away there to get you over that hump. Again, as you get older, that should really increase, you know, particularly if you end up having dependents, you know, children, etc., or if you have, you know, mortgages or rent to pay, that emergency fund should be a little bit bigger. Things like income protection, you know, late 20s, early 30s is usually the cheapest time to lock this in. What I mean by that is the younger you are, the less it's going to cost, because obviously you're younger, you're healthier, but it is very important. Even in your 20s, your biggest asset is going to be your income. So I would always stress that if you don't have your biggest asset protected, go and protect it as best you can, whether that's through an income protection policy or maybe a serious illness policy.
Okay, in terms of life insurance and serious illness, you know, when you're in your 20s, you're not really thinking about any of that kind of thing, but should you be, or is it never too late or never too early to be thinking about that kind of a thing? Or, you know, if someone in their 20s is to get that kind of cover, to what extent should they be covered?
It's something that we come across every now and again. You know, a single, you know, person comes in and they ask about life insurance, right? And the one thing is, unless you have dependents, you don't really need life insurance. Unless you have, dependents or debt. So basically you have a mortgage or you have kids, you don't need life insurance. What you should be considering if you're in that kind of a situation is some form of maybe serious illness cover that pays out a lump sum in the event that you get a serious illness. And again, the likelihood of you getting a serious illness in your 20s or 30s is a lot less than as you get older. So therefore it's a lot cheaper. So they're the kind of considerations. Again, income protection, as I said, is probably a bigger consideration at that stage.
Okay, debt and mortgage then.
Yeah, again, so we kind of hinted at it earlier, you know, try and stay as clear of debt as you can in your 20s. You know, obviously, you know, there may be a car loan, you know, maybe a credit card bill, that kind of thing. You know, try and clear the high cost debt as quickly as possible. You probably will be looking at maybe saving for a house, you know, a house deposit into your late 20s, early 30s, and then you're probably looking at maybe, that big spend, that big mortgage into your 30s and 40s, maybe when you get married, have a partner, you're looking at, settling down, that kind of stuff, you know what I mean? So basically try and stay away from debt as much as possible until you actually need to go into debt through a mortgage.
Okay, what about short-term savings then?
Yeah, again, short-term savings, again, in your 20s, you were looking at maybe for travel, car, career moves, that kind of stuff. In your 30s, you're looking at, as I said earlier, maybe building a sinking fund for things like home maintenance. Again, anyone that owns a house knows that, listen, you have to kind of maintain it, and there's always something that comes up on a year-to-year basis. You have childcare, other predictable mid-term costs, like, as I said, changing a car, maybe going on holidays, maybe saving up for an investment property, that kind of thing.
Speaking of investment, what about long-term investing? Do many people in their 20s, in your experience, start or either consider or even get actively involved in investing? Or does that tend to come later?
Yeah, it's not really a priority for most people, we would see, in their 20s, mainly because, long-term investing tends to come really after you have your mortgage maybe and your house bought. And at that stage, and you're kind of looking at, your budget, you have a few quid extra at the end of the month, you have your sinking fund or your short-term savings are kind of looking after themselves, and then you have a few quid, as I said, to spare at the end of the month. You're kind of saying, right, let's put that away for the next 5 to 10 years. So in your 20s, it generally isn't a priority, but we do get clients who come in that want to put money away, medium to long term. But generally speaking, it's kind of into your 30s and 40s. Again, when you look at maybe saving for a second property or putting kids through college, that kind of stuff, where you have maybe a little bit extra disposable income that you want to put away and get a better return on.
I was asking whether people in their 20s tend to consider long-term investing. Do they consider pension or retirement planning?
Again, not unless they have to. What I mean by that is, I suppose they will have to now with the auto-enrolment.
Or if they go into like a public sector job where,
correct,
they just get one. They get a pension.
Exactly, and that's great. And again, if you're lucky enough to be in an industry or be in a job where they offer you a pension, absolutely take it. You know what I mean? Because what you don't have, you won't miss. What I mean by that is, if it's been taken at source, whatever it is, your 5% or 1.5%, if it's the auto enrolment, you've never had that money, and at the same time, then it's been put away for you for your retirement, basically. So join schemes as early as possible. If you aren't lucky enough to have a scheme and you're auto enrolled, and if you have a little bit more disposable cash, pensions are very simple. They're like savings. The more you put in at one end, the more you're going to get back out at the other, and the longer you're putting it in, the more you're going to have. So the earlier you start, the better. So yeah, if you can start saving for your retirement in your 20s, absolutely do so. Again, for most people in their 20s that I come across, it's not a huge priority, but if they are lucky enough to be auto-enrolled or be in a job where there is a pension scheme offered, absolutely take it up. Okay,
family and children's education. I guess once you head into your 30s and 40s, they become much bigger considerations.
Yeah, and what we find a lot is when people have maybe a child or two, the priority is obviously, the children. They're not kind of thinking of their third level education when you're dealing with a screaming 2-month-old baby and they're keeping you up all night and all that kind of stuff. So what we find is maybe 3 or 4 years after maybe a child is born, that they kind of consider, right, what are we going to do with the child benefit? What I always say, if you have a child and you are in a position where you can put away the child benefit long term, do it. Set up a long-term savings plan, go into equities, go into the markets, and basically try and forget about that for the next 18 or 19 years. If you do that, you'll have no problem putting them through college if that's what they want to do. Again, like I said with the pension, the earlier you start, the more you put in, the more you're going to get back out. So yeah, try and do it as quickly as possible. Again, it's not possible for everyone, because obviously having children and having a family is quite expensive, but if you are in a position where you can put away the child benefit, do it as soon as possible.
Yeah, you've spoken about that before, and even if you don't put it away for the 18 or so years you've gone through, if you put it even away for 10 years, it all really goes, it all helps. Yeah. What about basic estate planning, Tommy?
Yeah, again, something that I would see very little of it in your 20s or 30s. But again, it is something, again, if you get married, a basic will, and I'm sure your legal experts will tell you that, a basic will is very important to have, particularly when children come along. But again, I would probably I would advise people to take advice on that. Again, if children have come along and you decide to set up a savings plan on their behalf, you might look at trustees and all that kind of stuff. So that's kind of basic enough, not really a huge priority in your 20s or 30s, I would say.
Okay, interesting question sent in from Morning Focus listener Mark for you. Tommy on 086 1800 964. Mark says, good morning. Is it recommended, Tommy, to get a loan even just to show you can pay it off?
No, that's a myth. So,
because I always would have thought, if you get a loan, what that really signals is you need the loan.
Yeah, it's a myth that you have to build up this credit, your credit worthiness by showing that you can repay this loan, all that kind of stuff. It's a myth in Ireland. They don't want you to have loans if at all possible. Where you'll see that is in the States, where you have, different states, hundreds of different banks. They want to see a credit history built up over time. So yes, absolutely, if you're living and working in the United States, it is a big thing. Here it's not. It doesn't really matter what they will look at. They will look at, your income. They will look at your other debts. They will look at your ability to pay based on your income and other expenses, basically. So it doesn't really matter if you have a loan or not. Well, sorry, it will matter if you have a loan, in that if you do have a loan, it'll bring down how much you can repay on a mortgage. So no, that's a myth that basically you should have a loan in order to prove that you have a good credit history, basically. No, it's a myth.
Well, Mark is making the most of his time in the spotlight here. He has a follow-up question. He says, so how do you build up a credit score then?
So credit score is not really built up as such. The only time you have to worry about a credit score is when you have a black mark against you. So if you did have a credit card in the past, and I've told this story before, I had a client once upon a time. He went to college. One of the banks was offering a £100 overdraft if they open up an account with them. Of course, he opened up the account, took the overdraft, went on the beer for a couple of days and forgot about it. And 12 years later, when he was going for a mortgage with that said bank, he didn't get it because he had a black mark against him.
So that's bad enough to have a black mark, but when it's a €100 overdraft.
Yeah. No, it didn't preclude him from going to other banks, but with that specific bank, absolutely, done and dusted.
Wowzers.
So just be careful.
Folks.
Be careful, exactly, yeah.
Okay, I don't know if you have anything to bring us from the markets. I wonder, the blockade of the Straits of Hormuz, has that caused any eruptions?
It's just volatile, it's gone up one day, it's down the next. The world index year to date is up nearly 3%. I think the last time I was on, it was down or it was even. The S&P is back in positive territory, up 2.1%. That's up about 5% in the last month. It's just so unusual. Gold year to date is up 12%, but it's down in the last month about 3%. You know what I mean? Oil is the big mover. Obviously, it's up 55% year to date, and it's very volatile. Every day you're going to hear something different. So, oil prices go up, oil prices go down. We see it at the pumps every day of the week. So, like we always say, short-term volatility is the price you pay for long-term gains. Don't panic. But if you are panicking and you need advice, give us a ring.
Okay, brilliant stuff. Tommy, thank you as ever. I know you're looking forward to a quiet weekend. Only joking. Wishing you and Brian the lads the best of luck on Sunday. Tommy Corbett with us from Carey Corbett Financial Solutions.